Welcome to Taking Stock for the week ending the 3rd of December 2021, where today our Managing Director and Chief Investment Officer, Tim Lincoln, is joining me, Kien Trinh, to stream to you all things share market. Welcome, Tim. I can't believe the year is coming to an end so quickly.
Yeah, it's funny, isn't it, Kien? And hello to you and everyone. Yeah, it's just bizarre that in a year that you've thought because of all the lockdowns and being confined to home life a lot, the year would have dragged along quite slowly, but it's certainly flown, hasn't it? It's just crazy, yeah, that we are getting close to Christmas.
Yeah, that's right. And also November, it's come and gone as well. And the month of November was quite flat for the Australian markets as it grapples with the concerns of this new COVID Omicron variant, which could potentially prolong the bottlenecks and supply shortages that have led to higher inflation in recent months. And despite this, our Star Growth stock portfolio was up 1.1% in November, leading to the outperformance of the portfolio over the longer timeframes, specifically the year and the 3-year periods, which included that severe rotation towards cyclical value from growth. And positively as well, our transition towards our optimized Star Growth stock pot model over the last 2 months has also helped drive the outperformance, with our Star Growth stocks returning 2.7% for the quarter compared with minus 1.8% for the market. And that's an outperformance of 4.5% in 3 months.
Yeah, great result, Kien, and I'm sure our members are really grateful for that. And it's good to see the new models off to a really good, strong, positive start. It's early days, touch wood. We want that to continue, but yeah, it's really encouraging to know that our members are gleaning the positive outcomes from that. Also with the Lincoln Australian Growth Fund too, Kien, it's done well too, in line with Star Stock results there. We're fully transitioned as well. The Star Growth stocks have in Stock Doctor, so is the Lincoln Australian Growth Fund, fully transitioned to the new optimised model, and it's off to a really good, strong starts too. So good results. Meanwhile, Star Income stocks have done well over the month, with Star Income stocks portfolio outperforming the market by some 0.8%, which is great. Over the long term, the Star Income stocks have not only managed to pay an attractive dividend that's been higher than the market, but has outperformed the ASX 200 index as well. So good dividends there, together with some capital growth. So members will be happy with that also. This is not an easy feat when you're invested in mostly defensive income generating stocks. So to outperform as well as generating income in defensive, really good indication that the methodology is strong too. Also, Kien, the Lincoln Australian Income Fund, it continues to ride on the curtails of the Star Income stocks too, and really wrap that it's delivering on its objectives of some total return and capital growth, but a wonderful yield of circa 8% over the long term. So really delivering on its objectives in line with Star stocks. And a quick mention, the US fund, we're now reweighting the portfolio on the back of the quarterly results, with some interesting transitions going on as we speak. But it also is enjoying this incredible bull run in the US, both the hedged and unhedged funds. So yeah, we're really certainly making hay while the sun's shining, Kien, in this low interest rate environment.
Yeah, Tim, it's been certainly a big year in the US with the bull run, as you mentioned. But just more recently, news of this COVID variant, the Omicron, has sent jitters across the equities market. And the concern here is that this variant is more contagious, leading to lockdowns and could potentially lead to the downside risk to consensus earnings growth expectations. But it's still unclear how Omicron will affect the economy. But historically, viruses tend to become more contagious but less deadly over time, as was the case with the Spanish flu, which eventually mutated into a more common seasonal influenza. And as can be seen from the chart on screen, the previous variants of COVID have had little impact on global growth, despite a large increase in cases, Tim.
Yeah, it's fascinating, isn't it, Kien? The economies just keep steaming ahead. But, it is really the volatility at the moment. In the last 7 days, we're seeing 2% shifts in market performance intraday. You look at the US overnight, it's meant to be opening strongly. Then it falls 2%. The next night, it's meant to be down, and it ends up, it's just all over the place. Same here in Australia. The volatility over the last 7 trading days has been incredible. But it is all driven by this new variant of the COVID virus, together with inflationary fears and increasing interest rates in the future. They're the two themes. So, you know the old saying, Kien, and our members do too, really important that we separate the noise from the facts and block out things that are unnecessary. And you know I don't like to get into too much discussion around macro economics and macro themes, but I think it's important too that we do understand that the market at the moment is incredibly resilient, with central banks and governments prepared to stimulate the economy if needed. They'll continue to do that, which is incredible. For example, despite the extended lockdowns in the last quarter, Australia's GDP growth only fell by 1.9% against market expectations of a 2.7% decline. In fact, over the last year, Kien, the economy still grew by 3.9% in this environment, which is just incredible, underpinned by the massive $26 billion emergency government support to households and businesses. So stimulus is fueling a lot of this growth. We understand that. And despite this risk of this new COVID variant, the RBA expects the economy to grow a further 5.5% in 2022. Therefore, we believe market volatility represents a real opportunity for investors to continue to buy high quality businesses, being obviously our star stocks.
That's right, Tim. And all this volatility is also giving opportunities for a lot of companies. And a key theme this year has been this strong level of merger and acquisition activity within our star stock universe as well. And this news recently just came from metal detection and essential communications company Coden, which acquired UK-based Broadcast Wireless. Now, Broadcast Wireless is a specialist distributor of broadcast quality video and audio via wireless, microwave, satellite, and fiber links as well. And although the acquisition size of 3.7 million is insignificant, at less than 1% when you're comparing to Coden's 1.7 billion market cap, the deal makes strategic sense as it aims to improve the company's remote production capabilities. And this acquisition is expected to lead to a 4% uplift to its earnings growth, anticipated to be around 10% this year.
Yeah, Kien, very interesting acquisition, isn't it? And it's been on the back of a series of acquisitions over the last few years for Coden. Who would have thought, from simple gold detectors and radio technology to the business size they are now? But that's quite common in our marketplace. We've seen a lot of small companies turn into quite large entities, haven't we, over the last few years? Just incredible growth in the M&A or merger and acquisition activity. But Kien, I've noticed that Coden's share price has been under a bit of pressure of late. Now, that can represent opportunity, obviously, for the opportunistic investor who really believe in Coden and the model and where they're heading as this now global entity. But trend-sensitive investors should note that Coden's share price has turned bearish on both the SD Max and SD30 TSR technical indicators under Golden Rule 4. As such, they should remain on the sidelines until more favourable price trend emerges.
Yes, Tim, and also on the acquisition front, we had homewares retailer Star Growth Stock and Star Income Stock, Adairs. They recently made an acquisition of furniture retailer Focus on Furniture for around 80 million, which is roughly about 12% of Adairs' market cap. And although the deal was mostly funded by debt, we believe the financial health of the business will remain intact due to the significant boost to revenue and earnings from the deal, Tim.
Yeah, fascinating. It's a real theme today, isn't it, Kien? Merger and acquisitions, and you're right. Revenue from Focus on Furniture represents 25% of Adairs' revenue, with the earnings growth recently being revised from negative 19% to negative 14% on the back of the deal. So it's a big acquisition, and these are the ones we've really got to pay close attention to. The acquisition should also increase free cash flow and support the forward gross dividend yield of 9.5%. So, all positive for the income-seeking investor, but it is a large acquisition, so we need to really keep our eye on it, as you and your team will, Kien.
And also, Tim, another acquisition as well from borderline Star Growth Stock and Star Income Stock was debt collector operator Credit Corp as well. The company is set to acquire radio rentals That's a business from Corp Group for a total consideration of 60 million, which again is quite immaterial when compared to Credit Corp's 2.2 billion market cap. And the acquisition allows the company to penetrate the online retail appliance leasing market. And this should help it drive net profit margins, currently at around 22%.
Yeah, fascinating story. And it was a real reminder for me because I remember quite a few years ago now, Thorn Group were a star stock. And when we were analysing the stock at the time, it was Radio Reynolds and other companies that operate in that space. Thorn were really on the acquisition trail. So to see them now divest of Radio Reynolds is quite interesting. Just a nice reminder of the past. But in addition to the acquisition, Kien, the company also announced an upward revision of around 5% to its financial year 22 earnings guidance. You can see that under Golden Rule 3. And this should lend support to the gross dividend yield, currently a modest 3.4%. So Credit Corp, what a star it's been in our star stock portfolio, Kien, for a long, long time.
Yes, Tim, and now turning our attention to the week ahead, there were no star stocks which will be reporting or hosting their AGMs, though wealth manager Perpetual, they'll be hosting their investor day on the 9th of December 2021. Also, no ex-dividends going next week. And those who are trend sensitive can use either our SD Max, which is the stock doctor moving average crossover, or the SD 30 TSR, which is the 30% stop loss or gains from its highs or lows. Both APA Group and Pro Medicus, they turned bullish on the SD Max this week. Meanwhile, there were no changes observed on the SD 30 TSR. In Under the Microscope this week, we expand on this merger and acquisition theme by highlighting borderline star growth stock and star income stock, GUD Holdings. GUD is a manufacturer and distributor of car parts. We're focusing on this company because they've made a bid for Auto Pacific Group for a significant amount of 745 million, and that is over 50% of GUD's market cap. But just to give you some insight into Auto Pacific, the company is an original equipment manufacturer, otherwise known as OEM. They also sell automotive accessories as well. And about 73% of the business is tied to OEM sales, with the remaining 27% pushed through to retail channels such as Repco, Supercheap and ArbCorp.
Yeah, similar to Coden, Kien, small business not so long ago, or small to mid-sized business now, it's making acquisitions to the size of $745 million. However, the risk is there, isn't it? 50% of their market cap. That's a really, really large acquisition, and it comes with significant active risk, doesn't it, Kien? That you've clearly articulated in the active risk section under Golden Rule 3. So really important that we zone in there. And they're also taking on $232 million in debt, which could potentially put at risk their financial health in the next period when we analyse the accounts based on this merger, including this merger. So TLTAI in particular, which is our gearing or debt ratio, total liabilities to total assets less intangibles, that could come under real pressure with the size of this acquisition and therefore tip the health rating, because we want to see that companies can service their debt from cash flow. But this is a big acquisition. So Kien, what is the motivation behind this deal? What makes GUD so confident that this is a great bolt-on deal? And will there be any dilution to the earnings and dividends investors receive that you can see?
Yeah, there are a lot of risks there, Tim, and GUD wants to gain a foothold in the four-wheel drive accessories and trailing market as well, which has experienced significant growth over the last few years.
Yeah.
Auto Pacific, now they've got a prominent 85% share of the vehicle towing segment and 15% share of the accessories market as well. And the size of the acquisition and the dilutionary impact of around 48% to its existing shares is also a concern to us as well. But the acquisition is expected to lift earnings before tax by 70%, which could offset that dilutive impact from the capital raising. So right now, the market expects the free cash flow to fully cover dividend payments, and the payout ratio of around 76% seems unstretched. However, Tim, we will continue to keep a close eye on any changes to the forward metrics, which could prompt us to remove the stock in the near future.
Yeah, thanks, Kien. Great insights, but I think our members need that reassurance from you that you and your team will be all over this stock. And if those active risks do escalate, or we just lose not the confidence in the overall business, but just worry about that, especially its financial health, sustainability, and sustainability of dividend, then you'll be quick on the button there to remove them. But really encourage our investors who especially invest in this stock to keep a really close eye on things and give you and your team a call if they'd wish to discuss anything further to help them make an informed and confident decision. The gross dividend yield, Kien, is currently 7.7%. It certainly looks really attractive, but again, it comes back to the sustainability of that dividend going forward relative to this acquisition. GUD had a placement to help fund the acquisition as well, and in the Lincoln Australian Income Fund, we participated because we do have a holding in GUD in the Lincoln Australian Income Fund, and we got some $3 million of stock. Now that $3 million took us over our equal weight position that we try to manage the income fund around, and we got that at around a 14% discount to current share price. We're actually going to treat that as a short-term trade. So if we can get a nice profit on that 14% discount on that $3 million placement, we'll be out of the stock pretty quickly to bring it back to our equal weight position, Kien.
This year has undoubtedly been one of the biggest years for mergers and acquisitions. And in our earlier Taking Stock video on the 17th of September, we helped investors identify takeover targets by using the powerful filter tool on Stock Doctor. This week, we take the opposite approach and scrutinize the impact of an acquisition from the buyer's perspective. So the question is, how can investors assess the impact of an acquisition to the parent company? Normally, acquisitions are means to extract value either through synergies, build market share, and improve pricing power. But the value from the synergy is tied to the price paid for the acquisition. The higher the price, the lower the return on investment. Therefore, investors should scrutinize the price paid and compare it to valuation multiples for other similar businesses. Also, management motivation is another important factor to observe. As Charlie Munger once said, "Show me the incentive and I'll show you the outcome." Investors should figure out if management is incentivized by absolute metrics, like achieving a set earnings growth figure, or are they driven by relative return metrics like return on equity or return on invested capital? And we prefer the relative measure because their interest is more aligned with shareholders, Tim.
Yeah, Kien, and we see a lot of acquisitions fail in the future, don't we? Especially if it's a radically diversified acquisition where it's not aligned or in parallel with their true business model and their core capabilities. But another key factor to observe too, Kien, that can put things at risk, and we've mentioned it a bit earlier, is how they actually fund the acquisition. Now, deals can be funded in two ways. Firstly, heavily by debt. If it's a large acquisition, it can be a heavy reliance on debt, which could increase return on equity. So our return on equity ratio under Golden Rule 3 can improve, but it also increases the insolvency risk, the risk of complete corporate failure if their future cash flows are impacted by higher interest payments that they can't meet their commitments on. So how much strain does it put on their cash flows to service that debt? And if it's an incredibly large acquisition as a percentage of their market cap or total asset base, it can put that strain on. And we know a deterioration in health and a deterioration in insolvency risk isn't good at all relative to our model, and especially financial health under Golden Rule 1. On the other hand, if a deal is financed by equity or a capital raising, this could lead to a dilution in shareholder returns and dividends because the number of shares will increase. Therefore, it's really important to understand the timing and the quality of the earnings that are being generated through the new acquisition and the cash flows to see whether the additional profits and cash flows can offset this dilutionary impact. So it's all about having that really strong confidence and faith that this acquired business will add value to their core business model going forward, Kien.
Yeah, Tim, and it can be quite complicated, but if you
Yeah.
have any questions, feel free to contact our research team and they'll help you with any of your questions. But certainly the large acquisition by GUD Holdings represents a good case study on this, Tim.
Yeah.
But thanks for your time today.
Yeah, great case study, Kien, and a lot of M&A activity going on, and it's understandable. A lot of businesses are really cashed up, high quality, but we've got to make sure that it's of a manageable size, and it does align with their true core capabilities. Really important. Great sitting down with you again. Love sharing this with our members always throughout the year. This is my last one for the year, so look forward to watching you and your team deliver over the next few weeks to our members, but all of our members and investors in our fund. Thank you very much for your incredibly loyal custom. We love treating you as part of our big extended family and align our passions to share market investing with each other. So all of our members, investors, have a wonderful Christmas, have a prosperous new year, and I look forward to catching up with you all in 2022.
Thanks, Tim. To everyone, have a happy, healthy, and prosperous week.